it sure seems younger people are struggling more than ever with high debt loads. New data from insolvency firm Hoyes Micheloz this week show that about half of the insolvencies filed last year were by millennials, average age 33. This group had unsecured debt averaging $47,283. 30% of the debt held by this group is in the form of student loans. Many are also turning to high interest loans for relief. 55% of the cohort has a high cost loan. And on average, those loans are $11,940. So what is the best advice for younger Canadians struggling to get their house in order and probably dreaming of owning one? Janet Gray is a financial planner with Money Coaches Canada. Thanks for being with us.
Hi, hello.
So let's just start with this. It feels a bit shocking. How much behind the eight ball does it put somebody if they are, while they're young, struggling at a mountain of debt?
It truly does. I mean, it's your starting on the back foot, as they say, and it really does take some discipline to get through it. And it wasn't developed overnight, the debt, so they also have to give themselves some time to realize that they have to pay it off over time.
So obviously people get kind of under this mountain and they'll have different types of debt, including credit card debt, lines of credit, and these high interest loans. When somebody is kind of struggling with debt that feels overwhelming, before they get to that insolvency, what's the advice you would give them about trying to kind of be rational about an approach to paying it down? What's the best way to be methodical about it?
Yeah, really it is to have a plan and figure out, okay, how much surplus do I have, or how much can I control, and how much can I add to the debt, and then have a plan and realize, okay, I figured it out, it's going to take me 4 years. Well, 4 years it is. And then just be patient and pay it off methodically, persistently, and you'll get there.
We often say, of course, that the younger you start saving, the better the return. We know that's true mathematically because of compound rates of return. In fact, you have to save much less if you start earlier in order to get to the same place. But how do you save when you also have debt? Do you tell people to do both, or is that a bit counterintuitive?
Well, yes, it is. But I do tell them to try and do both. But it's really just more of focusing on a reward. Like take 95% of your money, surplus money, put it to the debt, and then put a tiny sliver towards savings. That way you can feel that you're making movement ahead on two different fronts. And then you've already established a savings habit. So when the debt is gone, you can continue and increase.
This note about insolvency, of course, it's terrible. Now, a lot of this might be consumer proposals, so it's not outright bankruptcy. But still, is insolvency a good option, especially for somebody that's at that kind of still building stage? Or would you say that's a kind of a worst case scenario?
It's a real handcuff that they're putting on each other. Now, sometimes there's no choice, but there are maybe some other options that they spoke to a credit counselor about. They might find that I can get on a repayment plan. My creditors will agree to accept my money at a lower rate or a longer period of time. So there are often other options. And I hate to hear that people are putting handcuffs on their future in terms of they may not be able to get credit at a time when they want to get another credit card or buy a car or buy a house.
Now, you're dealing with people across the whole spectrum, but they're people of some means because they come to you and they pay for your services to get a better sense of their own financial future and their plan. Is there something common across all of the people that come to you, a problem that they all have?
It probably is lack of awareness about where they're spending their money, because it's the old, needs and wants. And of course, we can justify a lot of our wants into a need, but it's really knowing, okay, here's what I absolutely need: roof over my head, food on the table. The rest of it is a choice. And then is your choice to pay off your debt or continue with your other pleasures and your other ways of spending.
Just a few seconds, but do we tend towards the consumeristic, we want it, so we have to have it? Could we actually change our attitudes a little bit?
It's so hard. It is. There's so much keeping us from doing that in terms of social pressure, peer pressure, all of that. It really takes discipline and persistence.
Janet, so good to have you with us. Appreciate your time.
Thank you very much.
Janet Gray of Money Coaches Canada. Well, of course, as rates have risen, variable rate mortgage holders have been struggling more than most to cope with a big jump in costs. Of course, there's no crystal ball on when rates do stabilize or how long they'll hold at these levels. So where's the best approach to thinking about and renewing or renegotiating an existing mortgage? James Laird is co-CEO of Ratehub.ca. James, great to have you with us.
Thanks for having me. So
this is kind of the bad news, I guess, for some, is that the odds of rates coming down, maybe being pushed out. So people are struggling under mortgages that are too pricey right now or feel too pricey. What's your advice about the power that they might have in renegotiating or rethinking what they're paying?
Yeah, Amanda, one thing we're doing with a lot of clients at the moment, especially as renewals come up, is to consider extending the amortization. So let's say you have 15 years left on your amortization at renewal. If you add, say, 5 years, so extend the amortization to 20 years, it has a pretty big impact on your monthly payment. And we looked at the numbers. If you had a 5-year fixed 5 years ago and you've been paying it off steadily, if you increase your amortization at renewal, extend the amortization by 5 years, your payment's actually going to stay about the same if you go into a 5-year fixed at today's higher rate. So extending the amortization is definitely something to consider at renewal.
We know that there's some concerns around renewals. Would you expect to see a number of people unable to do that? In other words, have to walk away from homes? We've seen that in the past in big real estate downturns. Does it feel as though this one might get there?
Amanda, it doesn't feel like that. I think, the best 5-year fix at the moment is about 4.5%. And 5 years ago, it was around 3%. So rates are up about 1.5% over that 5-year period. And everyone who got a mortgage 5 years ago was stress tested at a rate actually a little bit higher than the fixed rate that they can get today. So I think there's strain on households, absolutely. Mortgage payments are going up, as are every other expense. So strain certainly, but it shouldn't be to the extent where household budgets are breaking unless something else has happened, like a loss of job or something like that.
Obviously, the mortgage is the big one for most people in terms of the debt they're carrying and also the asset that they hope to be growing. As they change amortizations and try to negotiate a lower today cost, upfront cost, are people aware of what that will do to the length of that loan, but also the amount of the house they own, right? They will own less of that house sooner because they're changing the payment structure.
Yeah, certainly. I think, look, if you can stick with your original amortization schedule, that's obviously ideal. But look, having a manageable mortgage payment is very important. Another thing that we're looking at, and I was listening to your previous guest, is if you have debt outside the mortgage, like credit card debt or other unsecured debt, the renewal is a great time to consider putting that debt into the mortgage. It will lower the interest rate so that you have one manageable payment as opposed to your mortgage payment plus your credit card payment plus, a personal loan payment. So consider putting unsecured debt into the mortgage so you have one low manageable payment.
James, so good to have you with us. Appreciate your time.
Okay, thanks for having me.
James Laird is co-founder and co-CEO of Ratehub.ca. Coming up, it's one thing to want to tackle your debt problems, but what if the biggest obstacle is you? That's still ahead. But first, when it comes to debt, we all have some we don't really account for. It's our share of government debt. Thanks to the Canadian Taxpayers Federation, you can get a look not just at the total debt and how it rises by more than $1 a second, but your share of it, more than $34,000 each. Throw in provincial debt, and it's another $20,000 to $30,000, depending where you live. So if you're looking for a little more stress in your life, head to debtclock.ca. You're welcome. We're back after this.